Can you share with us your journey that led to the founding of your companies? What were the pivotal moments or challenges that inspired you both? I love this because this is all about the legends behind how your companies were founded. So Boaz, I want to come to you first. How did Sharegain come about?
I don't have any history of tech, right? So, but a history of capital markets. I used to be an FX derivatives trader in one of the biggest banks in Israel, and then grew and became a portfolio manager in various hedge funds. There, more or less, I started noticing an ecosystem called securities lending, and how opaque and how I call old school it ran. And I'm talking about, back 13, 14 years ago. And it got to the point that I thought to myself, I've got to give it a go. It sounds like a great idea. For me, everything is pattern recognition in life. So I thought to myself, this is almost like Airbnb, just for securities lending. And everybody who I met told me, listen, you're half a decent trader, keep on your day job, right? But probably that even pushed me even further to give it a go.
Excellent. Yorick, I've got to go to yourself. What's the legend behind BUX?
Yeah, the legend of starting with BUX. So I worked in financial services my entire life, but always quite associated to the tech side of things. And especially if you look at the investment space, I was always very interested in investing myself. I always had a latent interest myself in the financial markets. And at some point I noticed that it just was very difficult for me as a normal retail consumer actually to enter these markets, right? And starting that investment journey actually. And then I had a discussion with another person that worked in the retail investment space already for years. And actually he came up with the idea of saying, well, why don't we try to make something to break down these barriers and really make retail investing accessible, intuitive and affordable for everyone. And especially with the upcoming hype of using mobile applications, timing was perfect, we believed.
Something that you both said that was kind of interesting was you were talking about looking at similar but respective industries and going, I can see a problem there, I can see a problem there, there's a gap in the market. Since then, what have been some of the key changes and shifts that your industry has seen change over the last couple of years? And Yorick, I'm going to go to you first for this.
2019 was of course at the heights of retail investing, right? We recently had Brexit, the Trump election. We of course had in 2020 the pandemic. We had the GameStop hype. All kinds of events that have driven massive amount of retail customers to the markets. And 2022 was, of course, the complete opposite. And not in terms of latent interest, because that was still there, but definitely from a funding perspective and venture capital perspective, the intrinsic urge for these firms to really support retail investment companies, especially in the direct-to-consumer space, was, of course, changing massively. And that has shaped the markets quite a bit. But in the end, the biggest thing is that there is a growing interest in the retail investment space. There are more and more customers coming towards the markets. We're still onboarding massive numbers of customers every month, driven mainly by these younger generations that have a way more investment-driven mindset than a savings-driven mindset. And that's especially what we believe in, a further trend that we'll see for the foreseeable future.
I want to carry on with this kind of theme around private investors. Obviously, they're taking a big role within capital markets. In terms of the influence that they're having in the space, can we just expand on that a bit further about what role you see them historically having, but also moving forward?
We see more and more private investors that the lion's share of their, I like to call saving, or the financial assets are in investments. If you think about 10, 15 years ago, you had your savings accounts, and the large money were in saving accounts. Maybe in the UK you had, ISAs and SIPs, but that's it. Now the lion's share in the US and in Europe, especially with the younger generation, they look to investment. They buy money market funds, they buy ETFs, they buy, and not necessarily they don't do a lot of bets. But at the end of the day, the lion's share, not the fringe, are looking, the long tail as we like to call them, find themselves with the lion's share of their financial assets in investment portfolios. Now, that begs the question, as they grow up, they would want to get some leverage, maybe buying a car, maybe buying, I don't know what, and so on. How do they get those loans if they don't have proper pots in their savings accounts? And if you look at ultra high net worth individuals, this is what they do all day long. They have assets, they get loans against those assets. And one has to ask oneself, why can't we too? If I have £100,000 of a portfolio and I want £10,000 as a loan, why can my broker give that to me against my portfolio? Surely, 10% leverage is nothing for that portfolio in terms of managing it, and it's good assets, right? And so, from that point of view, why can't we? Well, in the US they do it. In Europe, we think that that's the next thing to happen, right? As long as it is done properly from a leverage point of view, we think that is the next big thing, what we like to call non-purpose lending, right? And when that happens, that will revolutionize the lending part as well.
How are the actions and preferences for private investors changing, and what are the implications for your industry, and how should they respond to this?
So if you look at the preferences of retail investors and how they're changing over time, I think if people get a little bit more sophisticated, obviously they want to have more value-added services. So it all starts with the beginning, and that is, what Boaz already mentioned earlier. We're, from a large perspective, at least currently still, we see, especially in Europe, that it's still a savings-driven culture to a large extent. Especially the older generations. I mean, retirement is often driven by the fact that they just have a large sum of money on their savings account and they get a certain interest on that and they live from their interest. That's how many people that are retired basically live, especially if you have amassed a certain amount of wealth over time. These newer generations, especially millennials, Gen Z, have more this investment-driven mindset. And therefore, they are more looking to diversify and create a certain portfolio, where especially the importance of ETFs is increasing. You see that especially those newer generations, they start to understand that an ETF is a great product to start investing in, and it's by far the most popular product on our platform as well, especially driven by these generations. Now, that's where it starts, because an ETF or a single stock equity is, of course, a non-complex product. At some point, you see that the value-added services become way more important for people. So then you shouldn't just stop with just the investment portfolio, but attach a card, for example, to their investment portfolio, so they can start paying, for example, in shops or online, with actually the assets that they hold under management.
How do you view the current relationship between fintech and financial firms, both from a technological standpoint, but also in terms of, we're going to talk about ABN AMRO, but of course from a product standpoint?
We need to be all realistic if you look about traditional financial services, right? If you look at these oil tankers, many of these larger financial services companies, they move in a certain direction. And it's very difficult for them to steer them left or right. Whereas you have these fintech firms that are like speedboats, right? They are very agile, they're very dynamic, they're challenges in the space, they move very fast, but obviously they're not as big as an oil tanker. And that gives certain benefits and has certain edges that can make, of course, the partnership with these larger firms very beneficial for both parties. People are very happy and they feel confident that their money that they've stored there is safe. And therefore that trust and reputation angle can play to the benefit of these fintech firms who have, of course, a new name. They're not really well known for retail consumers or for institutional players for that matter, and therefore still need to prove themselves. Now, that's one collaboration that you can have. Another collaboration is that there's a lot of knowledge and expectations and skill sets with other large players. For example, BUX has a very active collaboration with BlackRock. Now, BlackRock is the #1 asset management provider, of course, and especially if you look at the iShares offering, it's second to none, one of the best in the world. Now, if you have an offering that is really tailored towards retail investors and they can create packages that are very suitable for retail investors from the get-go, especially if they want to get started with building a well-diversified portfolio, then we can of course have a partnership as a fintech firm with BlackRock to make sure that we can offer these types of packages to our consumers.
What prompted BUX to partner with Sharegain?
Sharegain has created something that's absolutely unique in the market, right? If you look at securities lending, which is a very, I believe still, a very healthy way of giving retail consumers additional benefits to monetize their assets. We just wanted to get started with that, right? We saw the opportunity and there was no other player in the market that could offer it the way they do. Our strength is provide accessible, intuitive retail investment products and have a very easy mobile offering. That's where our strength lies, really the UI and the UX towards the client. So everything that's happening on the back side of things, on the back-end side, post-trading, for example, managing assets, you need to do it with specialists. And this is exactly what Sharegain is, an absolute specialist when it comes to monetizing assets under management that we hold from our customers.
Excellent. Now, of course, you're both founders of your respective fintechs. What advice would you offer for other founders out there navigating quite a changing landscape?
Make sure that you have the right team to start with, the one or two other people that you believe in, that you can work with. Make sure that you map it out properly. I wouldn't say build a 10-year plan, but understand that you're playing for the long run. Never build a business in order to sell it, because if you're not looking to run it and buy it, then nobody else will as well. Build a business to grow it, to understand it. Understand that there's a real problem, even if others don't think that it's a problem. But become a professional of what you do and build a business for the sake of growing it. And if it's very successful, people will come and buy it. I have a lot of people that are coming to me and saying, they have a plan how to build a business and sell it within 3 to 4 years. And I always laugh. It doesn't happen. And you need to recognize that you're going against the odds. 80%, 90% of startups fail. So why would you succeed? And that's the question that I like people to go back and think about. Why are you the one that will beat the odds?
Reflecting on your nearly 10-year journey so far, what moments or achievements are you most proud of? When you think, what's the first thing that comes to mind when you think of what you've done with your businesses that you're very proud of?
The easiest answer would be, we raised $80 million in one funding round or Series C. Or, I don't know, we've sold the largest part of our business to a tier 1 bank, ABN AMRO in this case. These are very easy things to say, but that's not something that I'm really proud of. If as a founder, as a CEO, because you're such in this roller coaster all the time, achieving something like that is more of a relief than something you're super happy about. And I can explain that for hours, but if you would be in my position, you would understand why it is the case. So actually the thing that I'm more proud of is the pivot that we've made from a hyper-growth company in 2020, 2021 towards a sustainable, profitable company in 2023. And that meant laying off 40% of staff, for example. It meant breaking open contracts. It's a lot more tough to be dealing with a company that needs to make adjustments in order to become profitable, make the hard decisions, than it is to raise a funding round, for example. Doing that, making that pivot, making that change through a very difficult environment, dealing with personal situations of people, dealing with contractual agreements that you have that you need to break open. Achieving that is something that I'm way more proud of, because that really requires a complete team effort.
Very well said. Boaz.
Couldn't agree more, especially on the reliefs. It's so true, so true. The idea of what we do, what we call independent agency lending, and building it for retail-facing financial institution, especially in Europe, didn't exist. I think that is almost a very fulfilling moment for me, because something that didn't exist now exists, and big financial institutions are coming in and saying, we want to use that service. I think that for me is always a reminder of how, how much one can achieve with innovation, right? The greatest saying by Napoleon Hill, whatever the mind can conceive and believe, the mind can achieve, right? So there's no real boundaries to what we can achieve. And for me, the whole journey is, as you said, it's ups and downs and ups and downs and ups and downs, and you can only connect the dots going backwards. When you do connect the dots going backwards, there's a lot of good things that one can tap on one's shoulder and say, actually, we've done a good job.